Good afternoon. This is Rich Morrison, and welcome to my latest Thinking Cap video on ECO for 2025. Why I think that this program really hits the spot this year. The government has made a key change to ECO for 2025 and at a very important time for the producers. So we'll dig into that, talk about why this is the blue light special here for this year. ECO kind of hits home with me and with NAU Country, as we were one of the two companies that really co-founded ECO, that we recognized early on that individual coverages prior to 2020 were not enough to give producers enough coverage to lock in profitability to cover their expenses. And so we pushed to get ECO included as a spring policy that would allow producers to buy up to 90 or 95% coverage. So some of the details about ECO, if you're not familiar with it, it is a county-based product. I think it's especially good for producers with a yield history that are as good or better than the county, or at least that tend to track with their county. It is 95% coverage, so it's the highest coverage that you can get that's going to be subsidized by the government. Again, this year, I think it could help producers to maybe cover their cost of production. And with a 95% level, it only takes a 5% drop in revenue, whether that's a 5% drop in price and yield or a combination of the two to start to trigger an indemnity. So once you're starting to get up into these higher ends, like 90% for stacks or 95 for ECO, it just doesn't take a whole lot to have a loss. Producers must purchase an individual policy in order to purchase ECO. You can't buy it as a standalone. And ECO is not going to be impacted by your PLC or ARC decision at the FSA office. I'm not going to talk much about that today, but ECO is above the ARC program. It's from 95 down to 86%. So it does not overlap the farm program decision. But to me, the biggest deal about ECO this year, Congress this fall, as part of another spending bill, they increased the copay on ECO in 2025 from 44 to 65%. That equates to roughly $10 an acre cheaper for corn, roughly $6 an acre cheaper for soybeans from that 95 to 86% band. And to me, that's a game changer this year. And I know in the past that a lot of us have thought that ECO was bordering on too expensive to purchase. This year, by bumping those copays up from the government, it's really going to make it a lot more attractive for more producers throughout much of the United States. So how does ECO work? Well, it's this green band across the top. And for multi-peril insurance, it's basically stacking coverage. Your MPCI coverage level down at the bottom, you can buy up to 85%. Your next band is either with SCO or the county ARC program, which covers from 86 down. Either with county ARC, it's a 10% band of dollars. With SCO, it covers from 86 down to your individual coverage level. ECO stacks above that, 86 to 95. So you're chipping into your deductible there for your policy. And that's a big deal, again, for producers this year with input costs not coming down, but prices look like they're going to be lower than a year ago. At least it allows producers to get some higher bands of coverage. And so we put together this producer profitability matrix kind of to be able to show why I think that's important this year. And if you're a producer, and this is an example I did in Southern Illinois last week, a producer with a 200 bushel APH, county's expected yield at 190. My farm expenses for corn are $850 an acre. You can see that up here in the red. And then without any farmer sell or forward selling, if I were to buy an 80% RP policy alone, you can see then down in the matrix the combinations of county and individual yields across the top and harvest price on the left-hand side. And 80% insurance in most cases this year is not going to allow most producers to cover their cost of production. It is going to put a floor under your operation. And if that's your goal with crop insurance, you're going to be able to do that. But that floor looks like in some cases where you have a price drop and or a yield drop or both, you're going to probably be in the red. So how do you fix that? Well, one of the big fixes to me is looking at ECO. And ECO, because of that 95% trigger, and even after I put in the cost of the ECO, I've gotten a lot better looking chart on here. Maybe didn't turn all the numbers green, but I got a lot of them into the green in the top left, and I've improved my overall situation even after this premium. And then if I'm worried about downside on price, I want to go ahead and forward sell some grain, use my multi-peril policy to lock in a price. And I think I got a way that I can, with this rally we've had in the market, maybe turn all my boxes green. So I would encourage you to take a look at this tool, look at your numbers and your expenses, and see how utilizing these other coverages is going to allow you to hopefully lock in a profitable year before you go to the field. So a few of the details on indemnities for ECO. It's expected and final yields are going to be based on RMA data now, which didn't used to be that way a few years ago. All of the crop insurance policies are doing that now. The final area yields will be released in late spring. The following year, indemnities get paid usually in the early part of June. The indemnities will be impacted slightly by the producer's APH. Any producer whose APH is higher than the expected county yield then will get a few more dollars or a little bit bigger coverage. ECO indemnities and individual indemnities are not connected. So this is a 9% band, a standalone band up at the top, 95 to 86. The county could have a loss, you may not, or vice versa. So what are we thinking for this year? Well, one of the reasons I'm a big fan of it on corn is the acreage number that we're talking about this year. This is the current year's balance sheet, this white column, the second column from the left. Stocks have tightened up a little bit on corn. USDA dropped us down to 1540, which for 7 straight months now, we've seen USDA lower the ending stock number. But as you look ahead to this coming year, Informa Commodities is factoring in 93.5 million acres. 94.6 is a number we just planted the year before. I think that's easily doable, and I'm hearing a lot of people talking possibly 95 million acres of corn. And then the third balance sheet number I put in was 97.2 million acres, which would be back to the record we planted, I believe, in 2012. So as you work through a balance sheet here, with a trend or even slightly below trend yield, production could be 15.5 to 16 billion bushels. I'm using strong demand numbers for next year. And even with those, you're talking about stocks building back up close to, if not well above 2 billion bushels in the year ahead. So if you think that's the case, do we think corn will stick in the 460 to 465 area where it's at today? Or do you think we're likely to see lower prices come fall? So as we look at December futures, this is as of midday on Monday. Market's trading in the mid 460s right now. We're back and forth on this trade war thing. We started the overnight trade talking about tariffs here this morning. Word is that Mexico, we're not going to be doing that at least for 30 days. So we'll see what happens. But if I also look at ECO as a put option on price. If we were to start at 464, and let's assume for the year that we're going to have an average crop in the county, on my farm, et cetera, then if price only drops 5%, you would start to trigger a payment. And 5% takes you down to about $4.40. So I look at ECO going into the year like a put option. And I know most of us aren't going out and forward selling the heck out of corn right now at 464, but I can buy ECO, which essentially would be a 95% put on 90 or on a chunk of on most of my production for the year. And so I look at it like having a floor at $4.40. So now we know that's going to change as production changes, as yields change up or down throughout the year. But another reason I like it right now is that the managed funds, hedge funds, have built a position very, very long in this market right now. We're starting out the month of February with the funds long 350,000 contracts of corn. And historically, they don't usually stick with that. And so if they were to sell, if they're to push this market down at some point, maybe it's because of a big acreage estimate, I'll be happy that I've at least got something locked in at a high level on this crop. Now, I've showed this in the past, but you can see where our history of crop insurance prices has been. I know I've talked a lot the last couple of years about comparing this decade to the last decade, where you had a blow off high in the 2012, 2022 years, the next 2 to 3 years, we've continued to chase the market down. And if this year is like a 2015, we ended up down in 2015 from spring to fall. Actually, for the next several years, we count one, two, three, four, five, six, 7 straight years, we had a higher February than fall price. And so if you think that that's possible again, then certainly ECO does make a lot of sense. In soybeans, we are a little tighter on stocks than what we thought we were going to be. At the world level, though, we're looking at a record number right now, following a record Brazilian harvest that's getting started. So, looking ahead to next year, I do think soybean acres will be down. I think we're going to give up a few acres back to corn. But you can see, even going through the balance sheets, we're still not going to run out of beans if you have a trend type yield around 52 bushels. And again, at the world level, I would assume Brazil is going to plant big acres this coming year. Based on the currency spreads right now, things are pretty good down there export wise. So I don't see that being a problem. Beans have rallied. We're back up well into the mid tens. We've bumped up against some key resistance, this downtrend line, the 200-day moving average line. So unless we can blow through those, and I don't really see a reason why, I tend to think that this bean market's probably getting a little bit toppy, probably due for a downside correction. And if you look back a month or so ago, most of us didn't think we'd be trading beans up in the mid tens again. We were talking back mid-December about going back to the eights at some point. So we've got a little bit of a gift here, part of that from USDA, part of that from the drought in Argentina that's probably going to take the top off of their crop. But the funds have gotten long beans as they are corn. Now, not as big a position, but they were long close to 60,000 contracts as of a week ago. So if there's a reason, that they go back to the short side of the market, I'll be glad I got something locked in. And again, kind of like corn, you look at the number of years following 2012, where the market's February price was higher, one, two, not in 16, 17, 18, though they were. So maybe it's not quite as dramatic as it is in corn. But again, we're working on that downtrend. And in 2015, the price did drop significantly, almost $1 from the base to the fall price. And so if you think we're following the same pattern like we did following 2012, then again, maybe we've got some downside risk. So those are the reasons from a price standpoint I like ECO. One of the things, the tools I wanted to make sure you knew about was our Indemnity worksheet. And I showed just an example here on corn with ECO only. And so if we were to start out with a base price on insurance at 463, let's say the harvest price this fall goes to 420. My APH on my farm is 200 bushels. So my expected crop value is the higher of the two prices times the 200, or 926. If we have a 9% ECO band, that band is worth $83 an acre. Now, I can buy 100% of that band. I can buy that down to as low as 50%. I can save a little premium money if I go down to 50% or any level in between. But then if there's a payment, I get paid a lesser percentage. So this year, with the added subsidy, the 100% level makes a little sense to me. So let's assume that the county yield was expected to be 190, ends up at 190, no change there. But because of the drop in the price, we've fallen over $80, $82 an acre in revenue, which equates to only making 90.7% of our expected revenue. So at 90.7, we're below the 95 trigger. We wouldn't be low enough to trigger a payment, even with 90 or with SCO at 86 or even RP at 85. But because I added this ECO this year, we're going to get some payment. And that payment's going to be 4.3% or almost 50% of my 9% band, which means that we're going to get about $40 an acre back just based on price drop only. So I'm not even accounting for yield at this point, but I'm primarily looking at price. And again, for a crop like corn, which I think acres are going to go up this year, when you add the subsidy in this year, I think it's a heck of a deal. Looking at page 2 of this matrix and worksheet, you can see the matrix version of this. So it'll show you exactly the price and yield combinations, how much money would be paid. If we were to have a loss in bushels and a higher price, like, say a 2012 type situation, that the guarantee goes up. The dollars go up because of the higher harvest price as well. So I encourage you to take a look at that worksheet as well. So one alternative, and I did mention this, producers can buy down the dollars of coverage, uh, anywhere from 100 to 50, but again, you get paid less, cost less. So this is what we're looking at for the year. Again, trying to protect that top end range, trying to get your trigger as high as you can to cover your cost of production. We think this is a great tool to be able to use as a put option this year for 25 corn and soybeans. So my goal, again, try to put all the pieces of the puzzle together, give you a good plan for the year. To me, this is the blue light special for crop insurance. I encourage you to take a look at it. So with that, thank you to listening to this Thinking Cap video. Hope you have a great day, and we'll talk to you again very soon.